I'm here. I'm here. Hello, hello, hello. Hello, everyone. This is the version of the multifamily news, and boy, do I have a lot of stuff to talk about today. Coming from my two favorite sources, The Real Deal, and also Viceroy Research, which I'm going to talk a little bit more in a moment. I am going to tell you that there are, let me see if I can get the names. Suzanne Kavanaugh, that's one of the names. Let me see, what other name do I want to give you? No, that's not the person. It's two women, Suzanne Kavanaugh. Maybe it's Rachel Stone. Yeah, maybe. But I definitely know Suzanne Kavanaugh. If you are a member, you subscribe to The Real Deal, you can actually see some of their stories are reported on video by the authors, the reporters. Suzanne Kavanaugh is one of them, and she's got another woman that she does the calls with, and they do a very good job on reporting what's going on with all the stuff that's happening in the industry, and especially with the multifamily. They're the ones you want to be following. So that's a lot of the articles that I'm reading from are from them. And I'm going to start with this. You didn't want to see it coming to this, but it has. And that's that the FBI and the SEC are now investigating one of the lenders that everybody has been using for years. And, they're one of the most aggressive. I'm trying to get my camera just straight here. They're one of the most aggressive lenders. And, the bridge loans, the floating interest rate products, it's all coming home to roost for these guys. And, let me just read to you the Arbor Realty. Pushes back against claims of short sale fraud. Now, if you remember on one of the past episodes of the news, I talked about how Viceroy Research was accusing them of fraud because they were not reporting, like they took a property back in foreclosure and didn't disclose that they were actually the ones. They created almost a shell company with one of their employees to buy back the asset. And that was what triggered Viceroy to report that they were committing fraud. And, when that happens, after the what's it called? The Bernie Madoff scenario with the Boston office of the SEC, probably the most corrupt and Keystone Copish office of any SEC branch. They couldn't figure out the Madoff fraud. And so when somebody comes to them like Viceroy Research and gives them a potential fraud situation on a silver platter, of course, now the DOJ and the SEC and the FBI are going to get involved. So Arbor Realty pushes back against against these charges. Arbor Realty Trust stands by its accounting and investing practices. The firm released a statement Monday, first reported by Bloomberg, as it faces an FBI investigation, which began after Viceroy Reports published a report in May accusing it of fraud. A short seller, now that is what Viceroy is. Viceroy is a short seller. They make their money by short selling stocks. They're trying to, they get out there, they badmouth Arbor. Arbor's stock comes down and Viceroy makes money. So Viceroy's out there as much as they can badmouthing Arbor in the hopes that their valuation goes down and Viceroy makes a ton of money. That's the argument. The other thing too is Viceroy obviously has to be careful. They can't do, commercial slander is a real thing. They could be dragged into court. So they've got to make sure that their information is accurate. So these are the things you need to be thinking about. A short seller, Viceroy, claimed an off-balance sheet Arbor-funded entity acquired properties that the firm foreclosed on. The foreclosure would have allowed Arbor to avoid writing down its loans on the properties. Viceroy noted Arbor excluded West Chase Houston, that's the apartment complex, a group of apartment buildings that were allegedly foreclosed on from its quarterly report. But they went on to say that Arbor's financial statements are audited by an independent auditor, and its quarterly reports are also reviewed by its external auditor. Arbor stands behind its accounting as well as originating and investing practices. So in this particular article, our Viceroy is saying, hey, you guys didn't report that West Chase acquisition. And well, it was acquired by another company, so maybe it's not going to report it, but they're saying, no, that was a second quarter acquisition. It'll appear on our second quarter results. So just wait for it. The firm has faced diminishing stock prices in recent months. This comes amid a spike in multifamily apartment loan delinquencies over the past 6 months. Arbor's loan book is exposed to multifamily borrowers who used floating rate bridge debt to buy thousands of units when interest rates were low, only to suffer cash crunches when the rates increased in 2022. 35% of all multifamily loans are set to mature in the next 18 months. The challenges will be refinancing when borrowers are still forced to find new loans when the rates are still high. Folks, this happened back in 2008. I was a victim of it. It's happening again. You should take advantage of it. It's now's the time to get in there. I'm going to tell you another story in just a moment, and you'll see exactly who some of these people are that take advantage of it. Arbor is the most heavily shorted property stock in the country. Approximately 40% of the company's shares are on loan watch, which is not a good place to be. Now, I'm going to kind of jump around. We're staying in the Arbor story here, but it's going to come about in a little different way. I don't know if I'm holding up for those of you watching. This is the update and capital call summary. The name of the property is Regard at Med Center, Houston, Texas. 319 unit mid-rise wrap style apartment community. Beautiful property. Okay, I may mention some names in here that you might sound familiar to you. Arbor, the name of this is from the Viceroy article, all right? And this is, I'm going to read it to you because I don't want to, they're doing the reporting. They're doing the investigation. I'm just doing the reporting here. Arbor, with regards to fraudcasting. I said that correctly. That's how their title is right there. With regards to fraudcasting, not broadcasting. Underwater syndicates continue to unsuccessfully and fraudulently capital call investors for urgent restructuring funds. Restructuring plans are littered with intentional fraudulent misrepresentations, which will lead to an impairment to Arbor in any case. Okay, so let me give you the gist of what's going on with this property. This property. And I'm going to talk about the syndicators in just a moment. But what happens in this, and I'm not going to get down into the nitty gritty because I can talk about this from a 30,000 foot view. Here's the deal. These syndicators are in trouble. They're going to lose their properties. They go out to their GPs and LPs and say, hey guys, we need a cash call. The interest rates are killing us. We need an infusion. You got to pay us more money back. And what Viceroy is saying is where the fraud takes place is, and if you just sit down and work out the numbers, you will come to the realization that this property will never return any investment opportunity, any investment returns back to its people because of how high they bought it for and where the value is now. They'll never make the money back. But by going out and asking for good money to follow bad, they are inducing their investors, fraudulently inducing their investors to put more money in when they know it'll never happen. Can you imagine if you did a private placement memorandum and it was this situation and you're trying to raise money and telling everybody how great everything is? That would be fraud. So that's where Viceroy is saying the charges against Arbor. Actually, Arbor couldn't be faulted for that. The only problem they're finding with Arbor is Arbor has not reduced the valuation of this property on their books. That's where the problem comes in. But the thing is that the syndicators on this property, they're the ones with the problem. And let me give you some numbers, and then I'm going to tell you who it is. All right. So the borrower was Moneil Capital, Moneil Capital. And they sent a letter to all of their syndicate investors for a cash call. Right now, according to Arbor, the loan to value on this property is 99.6%. It's on their books equal to the loan amount. And what Viceroy is saying is it's worth far less than that. The debt coverage ratio, because of the rate cap is burning off, the debt coverage ratio is going to be 0.367% or 3.367. That means, folks, that any cash call will never be enough. According to the numbers here, they'll have to come up with 3 times, 2 to 3 times the original invested amount just to get back up to level. Wow. Holy cow. That's when you fish and cut. That's when you cut bait and you just cut and run and you drop the keys on the bank's desk, say, it's all yours. We're done. And that's what happens when you get these non-recourse loans. You can do those types of things. And many people are doing it. Why they're fighting for a cash call? If they just did these numbers, the same numbers that Viceroy is doing, they would see this thing's a lost cause. It's an absolute lost cause. Folks, I'm telling you, I've been in that situation before where we were better off dropping the keys on the bank's desk and walking away and starting re-engaging our business somewhere else. The appraisal on this property from the bank is using a 3.6 cap rate. Oh, yeah. Maybe back in 2020, 2022, but today, nothing is selling at a 3.6. I see a lot of new sellers trying to do seller financing and justifying the price that they want at a 3.6 cap rate. And you just have to laugh, say, sorry, pal, you can't get that rate right now. You can't get that valuation right now. You should have sold 2 or 3 years ago, and then you would have been fine, but you got greedy. Despite there being no recoverable value in any scenario for Arbor, it has forced GPs to capital call and effectively defraud syndicate investors into throwing good money after bad in order to keep the interest on Arbor's unrecoverable debt current, performing, and in the eyes of the deluded, unimpaired. Moneil has outrightly stated that the asset cannot be refinanced without a capital call greater than 2x, that was, I said 2 to 3, greater than 2x the initial funding amount. This is because no one in this market will provide a $52 million mortgage on this approximately $31 million valued asset. They bought it for the $62 million, and now it's appraising it at half of that valuation. Now, okay, I am going to read for you directly from the Viceroy report about the syndicators. And this is where things get a little ugly. And I feel badly, and I don't like to see anybody get themselves into trouble, but I'm just reporting the facts. Just reporting the facts, ma'am. Just reporting the facts. And it's 89 degrees here. That's cooling off. Here we go. Vinny Chopra, the Smiley, Mr. Smiley, nice man, very nice man. Everyone that I've ever heard working with him, have any dealings with him, said he's a very nice man. Vinny Chopra appears to be associated with Tootsie Capital, Tootsie, Touzi, a commercial real estate syndicator who raised millions to fund the purchase of Celsius Mining's Bitcoin farm. Why? I don't know, they jumped around here, but Tootsie founder Eng Tang has promptly disappeared with all funds and is under investigation for fraud by the SEC. Syndication made easy with Eng Tang and Vinny Smile Chopra. The company to whom Gem 1 granted a security interest over its miners, Tootsie, is now subject to major SEC criminal securities fraud investigation. There's got to be some reason. I think Vinny might be involved in that. But that's included in this report from Viceroy. I can't even begin to go through this. They do such an incredible job of documenting all of their work. So that's the update. But included in their report is the update and capital call summary. So obviously one of the syndicators, one of the LPs, got this sent to them, asking them to submit more, to provide more money, and Viceroy included it in their report. They went through it and really broke it down, and I can understand they're asking for this money. They're asking for this additional funds, but if you do the math doesn't math. I love that new expression. That's a new one. Let's see. Okay, so let's talk about. We're gonna talk about multifamily and the troubles that it's having, and then also where the opportunities are. Okay, so multifamily distress nearly triples in 6 months. The sketch of, I'm going to just read right through this because this is all great stuff. And this came from Susanna Kavanaugh, that reporter from The Real Deal, who's doing a bang up job on reporting what's going on in the multifamily world all over the United States, not just in the Sun Belt. She's also talking about New York as well. The sketch of multifamily distress drawn over the past year is now being shaded in by the data. The picture shows, it's that what she's basically saying. I've been saying this for a while. I've been saying this is going to happen. I'm saying, this is where the opportunities lie. And now the proof is coming home. The chickens are coming home to roost. The picture shows problems have spread beyond value add players squeezed by floating rate loans. Apartment deals marked delinquent or in special servicing and financed with commercial mortgage-backed securities jumped 185% in late June from January. We've noticed a spike in multifamily since the beginning of the year, said Mike Haas. That surge marked the largest increase among any commercial real estate asset in that period. The data signals the deterioration of multifamily loans isn't only ramping up, it's mushrooming. Now notice how they said the data signals the deterioration of multifamily loans, not multifamily. Multifamily, the fundamentals of multifamily are still very strong. What's killing this market are these loans. When you give away money for free, and then your financial model is dependent upon it being free forever, your underwriting is going to be wrong, and that's what we're finding out. The loan product, Credit IQ, I know those guys, good guys. Tracked largely isn't the debt tapped by the fix and flip borrowers who have suffered the lion's share of defaults and foreclosure actions this cycle. Those sponsors, including GVA, Tide Equities, which we'll talk more about in just a moment, and Nitya Capital, leaned heavily on other securitized product called CLOs, commercial collateralized loan obligations. The debt is floating rate and short term, making it a go-to option for investors eyeing quick exits eerily in the pandemic when interest rates were at bottom barrel lows. After rates skyrocketed, those borrowers, particularly the firms that had yet to wrap renovations, have struggled or failed to make loan payments. Let's see. Despite recent signs that cooling inflation could spur a September rate cut by the Federal Reserve, borrowers with loans maturing now are still being forced to find new debt in a higher rate environment. They're not going to be able to do it in time. There's going to be a huge transition of ownership over the next 18 months, strictly because of maturity defaults. Not because the market's burning it up and everybody's selling their properties, because the banks are taking them back. For some, that means bringing in more equity to the table. Blackstone, for example, was circling a $550 million refinancing of a $618 million CMBS Sunbelt multifamily loan earlier this year. Let's see. All right, so that gives you an idea of what's going on in this market. multifamily is still solid. The demand for our product is very solid. The rents have been coming down in different areas, not all areas. There was a great report that I just saw the other day from John. Let me see if I can pull this up. I definitely can pull this up. Let's see, Monday night. There it is. Here we go. All right, let me show you this chart because I thought this was great. Here we go. And jump on back over here. Now I have to present. Not slide, share screen. Let's see here. Hold on, folks. Let me find this for you. Okay. Present. Chrome tab window. Here we are. There it is. Got it. Okay, let me jump back on over to here so you can see me. I'll put myself right down here. All right. Now, if you can see this, what this is the apartment inventory growth, annual growth versus the Burns Apartment Rent Index. Burns is John Burns Research and Consulting, JBRC.com. Let me see. Do I have his book around here? He wrote the book, which I've had his partner, Chris Cooper, on my, not Chris Cooper. I've had his partner on my podcast, Big Shifts Ahead. Great book. But as you can see here, look at right down here. Here's zero. Everything close to this line on the vertical, their rents are remaining stagnant. To the left, those rents are declining. Look at Austin, Texas, one of the busiest multifamily sold properties markets in the last couple of years. They're between 5 and 6% rent deductions. They're having a rental loss. Their rents are coming down on average 5.5%. Then you come over here to 4, Chicago, Cleveland, Cincinnati, Milwaukee. These are growing over 3% per year. So you can see the slow and steady, the Cincinnatis, the Midwest, they're still growing. The ones that were flashes in the pan that grew very quickly, Austin, Jacksonville, Orlando, Atlanta, their rents are coming down. Now look at the deliverabilities. Austin is going to deliver 6% more units in the next. It's going to grow by 6% in the next year, next 12 months. Holy cow! All of these are all growing, but look at Salt Lake City, Nashville. Look at these numbers: 7% growth, and their rents are coming down. That's going to make a big problem coming forward, and we're going to see quite a bit of that, and how it impacts our industry. But that's it, folks. Go out, John Burns Research and Consulting. He wrote the book Big Shifts Ahead. Fantastic book. Regarding you know what? This gentleman, regarding Joe Biden's rent control. I had an article on that. I was going to bring it in. And I didn't because I've got so much to talk about right now, MPJ. So I will talk about that in the future. It's going to be dead on arrival. If I remember correctly, it had something to do with mostly just obviously federal rental rates, like Section 8, which they control it anyway. It might be mostly much ado about nothing, but I'll do some more research on that and report back to you on that. So. Now that you see what's going on in the marketplace, let's take a look at it from boots on the ground and how it's really hitting some of these guys. First off, I want to talk more about Tides Equity. That was a company, you hear me talk about them before. They're up to 5 foreclosures now in the Dallas-Fort Worth area. Let me talk for a moment about who they are. Back in June 23, Tides Equities actually saw this coming. National multifamily investor Tides Equities this week told its investors to expect capital call as it faces a cash crunch. That was back in June of 2023. So that's when they started seeing things turning south. That arose as questions have grown about their financial stability of many Sunbelt multifamily portfolios, which have faced pressure from rising rates and slowed rent growth. Tides, one of the biggest multifamily players in Texas, is facing the most significant test of its mettle yet, with thousands of units across the Lone Star State in the balance. In all the portfolio, they have over almost a 15,000 unit portfolio over the Dallas and Fort Worth area, most of them in the Dallas and Fort Worth area, about 8.93 million square feet. Together, they carry an appraised value of more than 1.3 billion, likely a severe undercount of actual value given Texas's murky appraisal system. Ain't that the truth? So remember, Texas is a non-disclosure state. They don't know what the property sold for. At least they hope they think they know, but they don't really know because you don't have to disclose. So if the real deal is trying to value these properties based upon the information they're pulling off the Texas assessors records, it is grossly inaccurate. They're saying it's 1.3. It's probably a lot more than that. Tides, yeah, here it is. Tides snapped up larger, aging apartment complexes across the region during the pandemic, acquiring some $6.5 billion worth of apartments across the Sun Belt in 21 and 22. Oh, John, great book. But John, remember, it's outdated. That book was supposed to be written, Big Shifts Ahead was supposed to be written for the years 2015 to 2025. You got one more year left. The next book that I would recommend that is going to take you to the 2030 is a book called 2030 by Mauro Guillen. I think his last name is spelled Guillen. And, I'm going to have to move my bookshelf. I got my bookcase right over there. I got all my books in it. And I'm always looking to grab them just to show you. But Mauro Guillen, he was a professor at Yale. That's the next book. And let me just tell you something, folks, just as an aside. You read Big Shifts Ahead. You read 2030. They all tell you, of course, that's demographers. They're telling you the sky's falling. That's how they make their money. But if you look at it that way, if you look at what these guys are saying as to the only way this country can solve its problems, they both have the exact same conclusion, and that is we need a strong, vibrant, healthy immigration policy. That's the only way we're going to be able to grow out of this dilemma of the debt that we put on ourselves, is by bringing in the best and the brightest from all over the world. And that's the best way for us to do it. Hey, I don't think letting all these people run over the border all these people running over the border is a good, healthy, and vibrant immigration policy. You got to increase those visas. I don't even know what they're. I'm going to get it wrong, so I'm not going to say it. Those types of visas that bring in the best and the brightest. That's the only way it's going to happen. But back in 20 and 21, the firm, Tides Equities, conducted assembly line renovations to the properties, drawing discounts by working in bulk with contractors and suppliers, and raised rents to cover debt payments. Many of these properties saw double-digit rent growth in that time, but were bought with floating rate loans. They didn't close the back door. Many of these properties saw double-digit rent growth. Okay, some properties suddenly became strapped for cash as the operating revenues increasingly went towards the rapidly rising mortgage payments. Tides said in its letters, many properties entered negative cash flow territory. Okay, so what's the latest with Tides? What's the latest? Here we are. Here's the latest. Tides hit with 2 more foreclosures in DFW, Dallas Fort Worth. That makes 5. And as Jess Harden writes in The Real Deal, Tide Equities could use a tourniquet. The syndicator, which pools money to buy multifamily properties, is struggling to stop the bleed on the multifamily portfolio it aggressively built in DFW just a few years ago. That makes 15,000 units looking for cash to prop up approximately 30 of their properties. Let me see. Tide purchased these properties back in 2022. Remember 2022? And by June of 2023, they're telling their investors, we need more cash. 2022, I bet you they were not buying anything at a discount. It's short-sighted, new to the multifamily world. So they're facing foreclosure. Tide is not the only multifamily syndicator active in Texas that has landed in trouble. After beefing up portfolios of vintage apartment complexes while debt was cheap, GVA, who we've already mentioned, GVA, another syndicator, is delinquent on more than $600 million in securitized debt and has lost a number of properties in Texas to foreclosure. Let's see. All right. So what do we do about this? Where's the opportunity? And that's what I'm going to close out on, folks. I won't even read that last article. I think MJP kind of alluded to it. It's actually that, you think this is just happening in Texas because of the floating rate interest products. No, now it's starting to come home to roost in the beautiful, fantastic multifamily environment of New York City. They're now not able to meet their numbers, even though their rents were growing. If you look at that chart that I just put up there, New York was on the right side of that vertical where their rents were continuing to go up, but it can't keep pace. It cannot keep pace with the what the new interest rates were. New York was different. When the federal fund rates topped out last July, Manhattan rents simultaneously hit all-time highs and have effectively held steady since. And yet, recent delinquencies signal that for the city's floating rate borrowers, record rents aren't enough to offset the rise in rates. Though the Federal Reserve had okayed 2 rate hikes, by the time one investor closed on his debt, few expected the benchmark rate to surge from 1% to 5.5% in little over a year. That's what did it, folks. And this goes back to what I was just saying. The fundamentals are still strong. It's the banks that are killing multifamily right now, killing the valuation. But that's where the opportunity lies. There's $2.7 billion in short-term floating rate debt tied to New York metro area properties. Nearly half of it is watch listed, and 85% has either matured already or is set to come due in the next year. Borrowers without rate caps have already weathered the pain of higher rates. But even for the subset that did protect themselves, maturity will hit like a brick. Property values have fallen as interest rates have surged and cap rates expanded, meaning lenders are asking borrowers to kick in more equity on top of the higher borrowing rate. The lifeline would be rate cuts, which the market expects the Fed could start in September. But few industry observers believe that cuts will run deep enough to ease those maturities. Folks, it didn't run deep enough when I was in that situation. It sucked, but that's what happens. H-2B visas. Thank you, John. H-1B visas. How about, is there a visa that starts with an E, like E1 or something like that? All right. Anyway, okay. So how do we take advantage of this? Well, let me tell you how one particular investor is doing it. Obviously, when I tell this to you, you're going to see a whole bunch of numbers like billions. Bring it down to your level, because there are opportunities at every level in this marketplace. Lind, L-Y-N-D, Lind, launches multifamily distress venture with Declaration Partners, a San Antonio firm. Now I'm going to mention the name of a Houston company. Now, I'm going to mention a Houston company, not by name, because I don't know the name. I asked my partner, I called up David Peters, and I asked him, hey, David, who do you think this might be that they're referencing in this article? And he had some ideas. I had some ideas, all speculation. Not going to tell you who we were speculating, but see if you have an idea of who this Lind company is talking to. A San Antonio firm with decades of experience dealing in multifamily distress is looking to get a slice of the many loan workouts happening between debt-ridden landlords and their lenders. The Lind and New York-based Declaration Partners formed a partnership. The venture is set up to close on several $1 billion worth of real estate. Lind, a multifamily owner-operator developer, has 25 years of experience dealing with distressed properties. Since 2008 financial crisis, it has purchased more than $1 billion of distressed notes on 40 properties, according to the press release. So they're going about it by getting the notes. This goes to exactly what I teach my students. Get in with the banks. Call your local lenders. Pick up the phone and talk to the workout department. Let them know you're interested. You want to buy properties. You want to buy notes. You want to get a discounted property. That's how these guys made their billions. The firm has a track record in sorting out complex situations, particularly in down cycles. Now listen to this. Lind advises on multifamily portfolios across the country. It recently entered a joint venture agreement with a Houston-based apartment investment firm to evaluate and shore up a 2,600-unit portfolio, according to the release. Many multifamily players. So who is that? Who is that? I know some friends of mine who are in trouble with big portfolios down in the Houston area. I'm just wondering, who could that be? Many multifamily, and I asked that question of David Peters, and he had different names than I was throwing out. So there could be many options that could fill that void. Many multifamily players have been squeezed by floating rate debt, which has value add syndicators riding a sinking ship. In Texas, Austin-based GVA, Houston-based Nitya Capital, and Los Angeles-based Tides Equities are among the players who are struggling to keep foreclosures at bay. Many syndicators purchase properties with collateralized loan obligations, or CLOs, which offered short-term floating rate debt. At the end of May, 46% of these CLOs were in some kind of distress. Huge opportunities exist, folks. The problem is bigger than companies staying afloat. There's also serious economic implications as the number of apartment loans marked delinquent rise. So you got to get out there. Don't think, oh, I know I started off the beginning of this news report of all the problems that people are having, but you know what? There are opportunities. More millionaires were made during the Depression than at any other time. So take advantage of this. Get out there. I mean, I tell you the story about how I lost a property I lost it in about 2015, but I bought it right this 2 months after Fannie and Freddie filed bankruptcy. So I owned this property all the way to maturity, and it never came back in value. So I had to give it back to the bank. And, then I looked at it and I bought it for $7.5 million. The guy that bought it from the bank bought it for $3 million. And then he sold it 4 years later for $7.5 million. He made $4.5 million on that deal. Ouch. That hurt. That hurt a lot. Because that was my money. Oh, terrible. All right, folks. That's all the news that there's fit to print. It's all good. It's always good. So just hang in there. Always be looking for deals. This is a sales and marketing business. You've always got to be prospecting. But if anybody has any questions, shoot me something offline, and I will see you all next Tuesday, I believe. I think I have to follow up. Some people have been asking me for if I could do certain things offline, and I'll bring it to this group. Maybe also doing just some more. Maybe just doing some more teaching as well. I think I got a lot of good feedback on Tuesday from that trailing 12 lesson. All right, everybody, great to see you all, and everybody have a great upcoming weekend. Wherever you are, stay cool, and we'll talk soon. Bye, guys.